you might have to pay a punishing new unrealized capital gains tax that could be coming. What this means is that if you have a $500,000 home and it rises in value to $550,000, you'd have to pay tax on your $50,000 worth of profit. But what if you haven't sold your home, meaning that you haven't realized any profit at all? And then where are you going to get the cash to pay the tax on your $50K of profit? Might you have to sell your home just to pay the tax? And then what if you could pay the tax on your unrealized capital gain? So you do, but then the following year, the home goes down in value. Would you get a refund in that case? So the unrealized capital gains tax proposal is a mess. Let's learn more. I'm going to talk with the best tax advisor that I know of in the entire world about this and more scary tax proposals coming with CPA Tom Wheelwright.
What the Democrats are proposing is, first of all, they're proposing capital gains rates at ordinary income rates. So they're proposing doubling the capital gains rate. That's actually as important as anything else. The second thing is they're proposing capital gains on gifts. If you give your business to your child, you have a capital gains, ordinary income rates. They're proposing capital gains when you die. So not only an estate tax, but also a capital gains tax. So then you get taxed twice when you die. So about 80 to 90% of your estate goes to the government when you die, if you're a business owner, as an example. Then they're proposing eliminating the 1031 exchange, which would mean that on a trade of real estate, you'd have a capital gains tax at ordinary income rates. Then they're talking about this unrealized capital gains. So if you do nothing but build your business or your real estate, the increase in value is subject to capital gains taxes at ordinary income rates. Now, their proposal is we have this tax when you're over $100 million. Okay, that does not seem to be in the news feeds right now, but that's what it is. They call it the Billionaire's tax, and they're calling it an alternative minimum tax on billionaires, but clearly 100 million is not a billion. That's only 1/10 of a billion. And the biggest issue, of course, is if you tax unrealized gains at 100 million, soon you're going to tax them at 10 million, then it's going to be 1 million. And that's the history of our tax law. The history of our tax law, remember, in 1913, when we passed the 16th Amendment, it was passed because it was only a tax on the rich. Right. It would never have passed if it was going to be a tax on the average person. And yet it passed because, great, we're okay taxing somebody else. As long as it's not our tax, we're okay taxing somebody else. That's pretty much what's going on with this unrealized gains tax is, oh, well, it's on somebody else and they have enough money, it's no big deal. Therefore, I'm okay with it because why shouldn't they pay more tax? That is what this is about. The challenge is as we saw with the income tax, eventually it will reach the average person or at least the average entrepreneur or real estate investor. Because, and think also, let's say that you build your wealth in real estate. And then when you retire, you say, well, look, I don't want to be doing active real estate anymore. I'm going to trade my, say, single family homes or my apartment building. I'm going to trade for a Walgreens, a triple net lease. Well, under their proposal, that would be taxed, okay? Because again, no 1031 exchanges over $500,000. So that means that if you accumulate your wealth through business or real estate, you pay a much higher tax rate than if you accumulate your wealth by investing in Wall Street through a 401k. Because if you invest in Wall Street through a 401k, you only have to pay tax as you pull that out. You're not going to be paying tax on the value. Now, that's assuming that they don't tax the increase in value of your 401k, which is also obviously a possibility. We do have, interestingly enough, people talk a lot about the constitutionality of this. The challenge with that is that we already have taxes on unrealized gains. So if you're a dealer in stocks, in securities, you do mark to market. That is meaning that you're going to pay tax on unrealized gains. And so there is actually precedent for this. And that's the scary thing, is that I think that they could point to that precedent and say, well, wait a minute, it's just an income tax And it's not a wealth tax. That's what they're going to say. They're going to say it's an income tax, not a wealth tax, because it's on appreciation, and appreciation is income. That's how they're going to go down this road. Will it start at $100 million? Absolutely. That's where it will start. Will it then drift down? Who knows, but likely. That's the history of our tax system.
Yeah, I mean, we've talked before about the phenomenon of the camel getting its nose under the tent.
That's
However, in this
this
case,
is.
I didn't realize there's already precedent for unrealized gains in a sense, as potentially if this is approved for those with $100 million net worth, then next it's $10 million net worth, $1 million net worth, and so on, like you described there. And, you know, when you talk about capital gains tax rates being stepped up so that they're at ordinary income tax rates, it's actually somewhat of an interesting philosophical discussion. In a way, it sort of makes sense that a person's gains from investment could or should be taxed at the same rate as one's, income when they go to their day job. However, why don't we do that by lowering income taxes rather than doubling capital gains tax?
But wait a minute. No, because it's a double tax. It's a double tax. Okay. So let's say that you're a business owner. Okay. And why does your business increase in value? Well, because you're making income, right? But you're already being taxed on that income. It's called income tax. Well, now you're going to tax what we do in this country, which a lot of countries don't do, by the way, is we tax it a second time. We call that a capital gains tax or a dividends tax, right? We tax it twice now. Now we're going to have that second tax at the same rate of the original tax. So if you think about it, you're being taxed on the same income twice. It's your income that determines your value. So you're being taxed twice. It's really not the same. So it's fine if you're invested in the stock market and that's where your capital gains are. That's a hard one to argue too much, although it does take liquidity out of the market, because what the problem with capital gains tax is being taxed over 28%. It's about 28%, is that you actually lower the contribution to the treasury because there will be fewer capital gains. There will be so many fewer capital gains that you actually lose money. The Tax Foundation, taxfoundation.org, I'd refer people to, has done lots of studies on this. And it's very clear that high capital gains rates actually reduce the amount of money that comes to the government. So this is purely political. This has nothing to do with let's generate more revenue. So you have to score this, right? So that means that you're scoring what's the revenue that's going to be produced. You have two types of scoring. One is called static scoring. The other is called dynamic scoring. Static scoring means that we're going to look at the capital gains we already have, and we're just going, if we double the rate, we're going to double the revenue. So that's assuming that we're going to have the same number and amounts of capital gains as we had at the lower rates.
Right.
Dynamic scoring means that we're going to take into account how people behave,
motivation,
when you double the tax rate.
Yeah.
Well, let me give you an example. Okay, so I'm a business owner. My wealth is in my business primarily. Do you think really I'm going to sell? I would ordinarily sell that business and take the capital gains immediately and be done with it. But if I have a high capital gains rate, I'm going to sell this over 20 years. So I'm actually going to defer my capital gains as long as I can because I don't want to pay those high capital gains rates. So that means less money to the government. That's what it means. So it actually reduces on a dynamic scoring. If you look at truly how people behave and have behaved in the past. So this isn't a new thing, right? We've had high capital gains rates before. So it's not like we don't know. It's not like we haven't seen this before. It's that for whatever reason, politically, they've decided that, wait a minute, the rich are out of favor. We need to tax the rich more. That's a very popular line. And therefore, this is a way to do that, even though by all calculations that are dynamic, it would actually reduce the amount of funds that come to the treasury.
Yeah, that does make sense about the double taxation Case in point, with an apartment building, if you increase its NOI, you have more income that can be taxed. And if you increase the NOI, therefore you've increased the value of the building, consequently the capital gains tax that you might have to pay down the road. Tom, maybe current capital gains tax are higher than I thought. Is the 28% capital gains tax number you mentioned current or proposed? What is that?
No, right now we have a 24% capital gains tax. Okay, we have 20% pure capital gains tax, plus we have a 3.8% net investment income tax. Doesn't apply right now if you're a real estate professional, but applies to everybody else. Okay, under the Harris proposal, then you would get a actually 39.6% rate plus 5% net investment income tax, regardless of whether you're a real estate professional. So that is 44.6%. That's the 45%. The 28% number I threw out that's the number the tax foundation says is the maximum you can raise it to without losing revenue.
You can watch this one next.